Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you expert guests and we try to show you a variety of what you can do with your money in the context of real estate and other things associated with make your money work for you so that sooner or later you can stop having to exchange time for money. And today I want to welcome an expert with a special, I would call it a niche because I'm absolutely not really an expert in it. Dan Deppen is with us. Hey, Dan, how are you?
Hey, Axel, doing well. Thanks for having me on.
Absolutely. I'm really grateful that you're here because I've heard about it and read about notes before, but I really don't want to claim that I know exactly what it is. I know legally what it is, but how it works and what you can do with it is kind of like mystic to me.
So I actually came to real estate investing in notes a little bit later in life. So I started my career as an engineer in the aerospace industry. So I did that for about 10 years and then went to business school and did an MBA and then went into product management, like worked for some big companies like Oracle and Amazon and things like that. And I had always been really interested though in investing. And so I started buying stocks when I was 19 years old, got into options trading for a while. And my options trading story was funny because as I was doing well with them, right? And then as I was like studying them and learning more about them, I realized that I had no edge and I had gotten really lucky. And just because of the spreads between the bid and the ask, I couldn't figure out a way to get an edge. And then I just shut it all down at that point. But I wanted to diversify money into real estate. Right. I had kind of invested in stocks through the dot-com boom and bust and the financial crisis and became intimately aware with how the market can flip right quickly. You can have these big down cycles. And then we kind of saw another one around the onset of COVID. So I didn't want to have all my eggs in that basket. And so I started by looking at kind of traditional rentals in the Denver area where I am. And this was like in the 2016-17 timeframe. And even back then, the cap rates were very tough. The economics didn't make a ton of sense to me in my backyard. And so I was looking for other niches to get into. Then investing is definitely a niche. And that's when I came across notes. And I really latched on to notes because growing up, my dad and my grandfather had been in the loan business. Not this specifically, what they did was a little different. But I kind of grew up around the idea of loans. And when I was in business school, I did a course in fixed income doing bond analysis, which isn't exactly the same as what I do in notes, but that was one of the favorite classes that I took. And I was also attracted to it because it's a large market in terms of the number of loans that are out there, but the number of people who do it are fairly small, right? And it's a little more, I wouldn't call it overly difficult, but a little more technical maybe than some other areas. And so that really attracted me to the space. So around 2017 is when I really went down the rabbit hole on notes and started to build up my business and get more involved.
Cool. So maybe we transition and you tell us a little bit. You mentioned it's a niche. And I think for most people, other than seeing anything between 100 and 200 pages worth of closing documents, it's very hard to understand what is all going on behind the front part of, okay, I'm getting a mortgage and there's a certain term, like is it 30 years or 15 years or 5-1 and 7-1 and all these kind of cool durations and a certain interest rate and amortization table. And that's about as far as it goes. So can you tell a little bit, what is a note? How does it work? How does it fit into the picture?
Yeah, so to try to simplify it a little bit, and one of the things people struggle with is they're so used to buying property, you have to kind of wrap your head around the fact that you're not buying the property, right? You're buying a loan. What you're really buying is the right to receive a stream of payments. So I'm going to buy this loan, and then the borrower, in theory, will make a payment of some amount of money for some number of months, right? So when I'm thinking about like analyzing these, if I'm doing the scenario where I assume the loan is going to perform, that's actually fairly straightforward, right? I can just say, okay, what am I paying for the loan? What are the payments over time? And I can calculate my return. Like that's pretty easy. Now, the big question is like, what happens if the borrower stops making payments or they don't make payments or they make erratic payments? Well, one of your rights as the buyer of this loan is collateralized by a piece of property, right? Now,
Right.
for the majority of what I buy, it's a single family residence. Although, I mean, at the end of the day, you can buy loans on just about anything. They can be condos or land or mobile homes. I've never
Right.
done this, but you can buy them on cars and all sorts of things like that. Or it could even be something that's unsecured. But what I'm doing as a person who owns the loan is my fallback plan is then if the borrower starts making payment is I can foreclose and take the property back. Now that's like the simple way to put it. The reality is the devil's in the details, and I don't want to, nerd out too much on the paperwork. And you could talk about the differences between land contracts and mortgages and deeds of trust and things like that. But at the high level, basically, you're just buying a payment stream with the fallback plan of the ability to foreclose if the borrower doesn't make payments. And then within notes, we talked about how it's a niche, and then in reality, there are kind of sub niches within that, right? So the most simple way to start, and like what I do in my retirement account, is just to go out and buy solid performing loans, right? Where the borrowers are making payments and the probability of it not performing is reasonably low. And if you go out and do that, it's very easy to buy solid loans with a lot of equity at double digit returns, right? That's pretty straightforward. One of the things I like about it, especially for a retirement account, and especially people who are either like getting close to retirement or they're in it, you can achieve returns that are in line with the long-term stock market average, but taking out the volatility, right? So what you can do is help remove that probability of if you have it all in stocks, there's some weird event and everything drops by 30% or whatever. Now, there are other niches you can get into the non-performing world where sometimes I go out and buy loans where the borrower's not making payments. And that's another thing that some people find puzzling. Why would I buy a loan if the borrower is not making payments? And that's where it gets interesting because now there's a lot of cool things you can do and there's a lot of scope for creativity, right? Like, well, a simple thing you can do is just hire an attorney and take it through the legal process and start foreclosure. But you can also do things like reach out to the borrower, or better yet, have your loan servicer reach out to the borrower if you're not experienced and trained in debt collection. And because now what I'm really doing is functioning as a bank. And I'm also buying these loans at a discount. And if it's non-performing, I'm buying at a pretty hefty discount, maybe 50 cents on the dollar in some cases, although mileage varies a lot. And I can see what's going on. And oftentimes I can work something out with the borrower to get them paying again. And you can often, people call it rehabbing the borrower instead of rehabbing a property. And that's always a big win for everybody when you can make that happen.
That was quite a bit of information all packaged together. Now, real quick, in this context of what you just said last, what would you say are the main reasons why borrowers stop paying?
There are many reasons. Three of the biggest ones I find are divorce, medical bills, and job loss. And those are three that are typically recoverable. So what happens oftentimes is borrower has one of these life events and they get behind, say, 6 months on their loan. And then if their loan is owned by a larger institution, either a bank directly or a fund that has more notes where they can't pay individual attention, it can be really hard just to get someone on the phone, right? Because they say, hey, I'm 6 months behind, but now I've straightened out this issue. What can we do? And there's no one to talk to on the other end. And now they're concerned because they know they're at risk of foreclosure. They can't necessarily just make up the 6 months. And then sometimes they stop making payments because they're worried. They're like, well, I could get foreclosed on. Am I just throwing this money away? And so when I buy that loan, it's nice because I can reach out to them directly instead of a larger institution.
Right.
They can talk to Dan and I can make decisions very quickly on what to do. You put into place forbearance agreements and trial payment plans and get things worked out. So borrowers are often very grateful in that situation. Now, there are some borrowers who just don't like to pay their bills and they just stop. And so I've had a number of them where we call the loss mitigation process, which is that outreach process, like that doesn't work. And then you go through the legal process. And I've had more than a few. I've had like 7 or 8 now that have gone all the way to the end of the legal process and the borrower won't make a payment to save their life. And then they do this full reinstatement at the last minute when they realize they're going to lose the property. And I'm always curious, like what the backstory is. Did they really just like rat hole all that money and save it? And then they were like, okay, I'll fork it over now. Or did they like borrow money from a friend they're not going to pay back? Or did they rob a bank? I'm always curious. I never asked, but I'm always curious what
Yeah,
happened.
absolutely. That is definitely an interesting question. Now, is there a particular type of property, and is it mainly kind of like within a couple hours of driving range from where you live, or can it be anywhere?
It can really be anywhere. So I've never actually bought a note in Colorado where
Yeah.
I live. In general, you don't see a ton of notes in the Western states because there's not a lot of distress. I'm buying mostly in the Midwest, like Michigan, Indiana, Ohio are my sweet spot, but it's kind of like Midwest and Southeast is where most of the notes are. You also see a lot of notes in the Northeast, but I don't tread into those areas too often just because the legal environment's very challenging. If you buy a loan in New York or New Jersey and the borrower decides to fight you, you might be feeding that money for 20 years, right? So they're
Yeah,
just not good
absolutely.
states to work within.
Right. And we do this for our single family or like anything that is between single family and fourplex investments with our clients is very selective in which states we actually starting to look for investment opportunities because exact same reason, because some states, if the tenant just becomes a nomad, you can't get him out. There's crazy eviction rules and all kinds of court leniency and what have you, right? And I mean,
Hmm.
it might sound a little harsh when people listen to us talking about it like this, but people have actually signed a contract and made a commitment. And when you try to help them and they basically show you the finger, it shouldn't be condoned. It should actually end the contract and have the consequences that they knew that they were signing for, at least my opinion.
Right.
Okay, so that makes sense. Now, one thing that is not necessarily obvious for me, and I wonder if my audience would say the same, is why wouldn't people that are struggling in this situation not just sell the property?
They can, and occasionally they do that, but they don't seem to do it too often. I mean, part of it is they have to live somewhere, right? If they sell the property, if they have equity, it could definitely make sense to sell the property and then rent somewhere else. And the other thing is a lot of the loans that I have are sub $100,000 houses in the Midwest, right? So my typical deal might have a 80, $90,000 property with a $50,000 loan balance or something like that. And a lot of times their payments are only three, four, $500 because some of these were written several years ago. And so in a lot of these neighborhoods, if they want to rent, the going rent might be 8, 900,000. So they have a pretty big incentive to try to stay there and work out. Although I have seen borrowers do things that were not rational. I had one in Cincinnati a few years ago. It was actually a land contract. So in a land contract, not to get too into the weeds, unlike a mortgage, it doesn't actually go to a sheriff's auction. So if you go through what they call the forfeiture process, you as the lender just get the property. There's no auction. And this borrower had a lot of equity. And I was almost pleading with her to work something out. And she didn't want to. And then got judgment. She lost the property. And then she called me afterwards and was just really sad. And she said, I didn't think that was going to happen. I don't know how she could have thought that was not going to happen because it was like all made super clear. And I was trying to, work something out. But yeah, sometimes borrow, it's one of the things with notes, right? There's another human on the other end and they have emotions and other things. And, sometimes they do things that aren't, perfectly rational, like, I hopefully would in that
Yeah,
situation.
agree with you. But one thing that I believe people like you and I and others that are in a sense experts or professionals in this area of real estate and real estate investing, I think we sometimes underestimate how low the level of education for the regular person who just happens once in their life to have bought a house. Like I, for example, had a similar example with one of my properties where we had a tenant who moved into the house right after I bought it and was freshly renovated, was basically moving into a new house. And they were in the house for 4 years, paid rent, no issue. And
Hmm.
then suddenly in the fall of last year, it started to get spotty with the rent payment. And so then my property managers reached out to see, if we could get them help through some charities or church or things like that.
Hmm.
And they were a little bit more like a clamshell. It felt to me like they were almost embarrassed to admit that they had some struggles, and we don't really, to this day, I never found out what really the struggles were. But what ultimately happened is, I mean, after a few months, you say, okay, well, if you don't want to do a payment plan, you don't want to really do anything, then at least give notice, move out, fix the place up and rent it to somebody else. And they just didn't react anymore. And then ultimately we went all the way through eviction. And the last thing I told my property manager, when you're actually at the court, take them aside and make them aware in the most friendly way you can what it means for them to have an eviction on their record. Those kind of circumstances makes you almost feel sad sometimes, right? Because not only are they now out of the house and lost the security deposit, they now have that mark on their record, unless they know that they're going to go to a different state, which I also find like a topic I shouldn't do a podcast about. Why is it not nationwide if you have an eviction? But that's a different thing. But still, within at least the general area that they are in right now, it just, you have that blemish on your record, and we want it, right? And I think you said the same thing for your thing. Oftentimes you want to help.
Yeah, it's not uncommon for people in that situation. They go into like a head in the sand mode, and it's very tough. And then, the other problem is, some of the levels of financial literacy are very low. I had a borrower once who was kind of a spotty payer, and he would send in kind of random payment amounts sometime. And at the time, this organization doesn't exist anymore, but there was a nonprofit credit counseling agency that you could hire as a lender to talk to your borrowers. They talked to him, and they came back and said, yeah, he legitimately did not understand that you had to send in a specific amount every month. Like, he would just send in a couple $100 if he happened to have it. And they said, no, send in this exact amount to the penny. Just do it every month by this day. And he legitimately did not understand that's what he was supposed to do. And after they had that conversation, he was good. So it's just a financial literacy issue in that case.
Yeah, exactly. And I mean, I have another example where we had a person who fell behind, got almost to the point where we actually went to court to evict. And then the judge said, there's 1 month that nothing happens, come back. So we go back, we say, hey, she stopped paying. He says, okay, bring her in again. Explain it to her. She says, yeah, if you give me 1 week, I can make this final payment and I'm all caught up. He said, okay, this is your last chance, 1 week. She actually makes that payment, all caught up. You know what happened? I had my monthly call with property management. He said, you won't believe what just happened. This lady just gave notice.
And she was leaving?
Yeah. Now, I mean, from an investor perspective, I was smiling as bright as you are smiling right now. So for me, that was mind blowing. So in a way, for our audience, guys, you need to understand this is actually really great when you find somebody who is believing so much in this market of eviction that they do everything and then ultimately leave, rather than just letting you as the investor and owner hang.
Yeah, interesting. I had one recently that really blew me away. So I had a borrower file bankruptcy and then reached out to the loan servicer and wanted to talk, which the whole thing, you can't just talk to the borrower if they file bankruptcy. Once we got that squared away, it turned out this gentleman has pancreatic cancer, has been doing chemo, has maybe 6 months, maybe 12 months to live. And he was moving to another state to be with his caregiver. And so in the meantime, he cleaned the house out. There was like a code violation issue. He took care of that. And he just wanted to hand the keys over, like in an orderly way. It's like, I don't have any heirs. And I tell you, if it was me, if I had cancer in a few months to live, I would not be super concerned about, Chase Bank that has the mortgage on my property. So yeah, people do some unbelievable things in all directions.
Yeah, and I wanted to also give a little bit of an example. It's not always bad. Not everybody is out there to screw you, but it would definitely, and I think we both agree on that, it's sometimes sad that our financial education is still so limited. And bringing it back to where we started with this, when anybody, I believe you can really say this, anybody who is getting interested in a topic, whether it's like your specialty with the notes or our specialty to help people out of state, far away, between where they live and work and where their investment properties are, to make it work with minimum effort after the purchase. You get so deep and you get so many different variations and all the details and all the moving parts. I think there's always a little bit of a risk that you forget that not everybody knows about all this stuff that we start accumulating year after year, more and more, decade after decade, in my case, like 2 decades now. And so these examples, I think, bring it back. I want to transition real quick before we come to the end of our show. Dan, could you maybe create an example for somebody who says, I really find this an interesting thing where I don't necessarily deal directly with all the other things that are related to the property and more on the loan side? If somebody were to say, Dan, how can I as an investor work with you and take me through an example on what the outcome could be? Kind of like not the best one, not the worst one, but like one of those middle of the road kind of examples.
Yeah. So, I mean, you want like an example of one
Yeah, if you were
or
to
how
just
they,
say, I came to you and say, hey, this is so, after the podcast, I was so intrigued by what you said and how this sounds, but I'm not sure that I fully understand. Can you just give me an example of what it could be?
just last week wrote this free ebook. It's about 12 or 13 pages.
Oh, cool.
And if you go to my Fusion Notes website and sign up for the newsletter, you get it for free. And in there, now I forget exactly what I titled it because I just wrote it, but it talks about buying notes in 2024, right? Because what a lot of people do is they'd like to tell their best story of notes that maybe happened 10 years ago under different market conditions. But
Yeah.
in there, I actually profile a couple notes that I bought earlier this year to show the kind of deals that you can get now. And then I've got a couple case studies in there of ones that I recently exited. Note deals take a while, so the ones I recently exited, I bought a couple years ago. But that's a good idea to get an example of kind of some of the things that you can do. And then on my website, I have a link to success stories where I've got a bunch of one pagers that show a variety of deals I've done. And there's kind of like the good, bad, and ugly in
Yeah.
there.
Would you mind reciting one of those if you have one at the top of your mind?
I had one recently that I just exited. It was in Arkansas. And so this was a performing loan. I bought the loan, and off the top of my head, I don't remember what it was, but it was probably like a 13 or 14% yield. It was a land contract, so you can get a little bit better pricing on those. And then the borrower paid reliably for about 2 years, 3 years or so. So I was just collecting payments, and that was really nice. And then the other thing I did was I did what's called a hypothecated loan. I took a loan from an investor, I think at 9%, and I refinanced myself out. And so what I did there was I created a little bit of a monthly income. I had a little bit of a spread between what the borrower was paying and then what I was paying for servicing costs. And then the loan I was paying to the investor has a little bit of profit left over. Not a lot, but a little bit. And then the powerful thing though about doing that was because I bought the loan at a discount, I retained the upside potential. And then recently the borrower refinanced and paid the loan off. And so there was about a $12,000 difference between my cost basis on the deal and what I owed the investor and what the payoff amount was. So I collected these little bits of income, probably maybe around $100 a month or so without looking it up for a few years. And then I had this $12,000 win at the end. Now they don't all pay off early, but most of them pay off, after some number of years. I forget what the long-term average is. It's like 7 or 8 years.
That also, I think, correlates pretty well with the average of how long people actually stay in the same location.
Yeah.
It gotten longer lately because of the interest rate situation, but it used to be until middle of 22, it was like 7.3 years or something like that. Now, the last thing I want to ask, and then we get to the final non-money related questions. Why do organizations that have made the loans sell them to Dan and other people like you?
So there are a lot of reasons for people to do that. So like a lot of loans that I buy, I don't buy directly from banks. Everybody like immediately thinks they're going to go down to their local bank and buy loans. And unless you have about 5 million plus to deploy, most people aren't going to play
Yeah.
in that world, right? And so I'm often I'm buying a lot of seller finance loans for one, or loans from other investors who do what I do, or from smaller funds, right? So if it's a seller finance loan, oftentimes the person who originated that, they sold it doing seller finance because the buyer couldn't get a bank loan. And so they really wanted cash. They did seller finance out of necessity, and now they want to free up their cash and sell the loan. If it's an individual investor, like somebody in my network, a lot of these folks, they don't just do notes, they do all kinds of things, right? And they're wheeler dealers. And so they want to have they're like, oh, I want to put money into this multifamily deal, or I want to do something else. And so they're going to sell a couple notes to unlock the capital. And if you're known as a reliable buyer who will move reasonably quickly and close, assuming nothing's wrong, a lot of times these deals just kind of find me. Some of my best deals have come from smaller note funds that are in the process of shutting down. So typically, people will set these up and they might have a life of 5 years or 7 years. And it's the agreement they have with their investors that after a certain amount of time, they're going to close it and pay them back. And
Right.
so they have to liquidate. Those are where some of my best deals have come from. So there are a variety of reasons. And at the end of the day, if someone's selling an asset, right, they're discounting it to some yield based on what the value of it is. And that yield may be higher or lower than the interest rate that the loan was originated at. And so these things are typically selling at discounts.
So there's a whole bunch of different places. And if people, even with the broadest view, think about real estate, there's so many millions and millions and millions of properties that almost all of them have at some point had or still have, probably the vast majority still have loans of all kinds of different varieties on them, right? So I don't think there will ever be a shortage.
No, there won't. I mean, even if you just look at the seller finance loan market, which is like one piece, there were 89,000 created in 2023. We're creating 80, 90,000 of those per year. That doesn't count all the ones around from previous years and then the other kinds of paper out there. It's one of the things that attracted me to the area, and the reasons why I still like it is there's a relatively small number of investors chasing these in a very big market, unlike some other forms of investors or other forms of investing where there's a relatively small number of deals that everybody and their brother is trying to chase.
And I can imagine with now more and more DSCR loans being made, that there might come a point where people either want to go in a different thing, either in the stock market or some other stuff, and they just want to get some of their money back. And I mean, what our audience needs to understand, if a loan has been going for a while, you can basically argue that the original person or entity that gave the loan already got some of their money back, right? So we're not talking 100% of the loan amount from the beginning if the loan is 3 or 4 or 5 years old already.
Right, and that loan's getting less risky as it goes along because the borrower's paying it down, and at least in recent years, property values have gone up. So the borrower has more skin in the game, they have more equity, and so,
Well, it's also, we have one lender that we're working with to finance investment properties, and she basically has a few people who come from the hedge fund industry, not as a hedge fund, but people who work there and made some significant amount of money. And he always calls it, there are people out there who just need to park their money for a little more than inflation. They don't necessarily stick around for the term of the loan or something like that. They just park it until something better comes along, and then they want to park it somewhere else. And as long as they come out ahead of inflation, they're typically okay, So so those kind of scenarios. So it's just a really broad field. So I want to really thank you to shine a little bit of a light on this kind of part of the market that most people have very little exposure to. Independent of that, I always like to ask 2 questions at the end of the show. And the first one would be, if you could meet anybody, then who would it be and why?
I think I would want to meet Ben Franklin. Just because the guy did so many different things, like he was a writer, and if you look at some of the things he did with his newspapers, like he would have been all about the internet and Twitter and probably trolling people. He had that aspect, and then like his politics, and then he was interested in science and traveled around at a time when it was kind of hard to travel around. So I'd be interested to talk to that guy and kind of see what he might think of the modern world.
That was the same reaction I had when I finished the biography of Leonardo da Vinci. I said, I gotta meet this guy. It's just too bad that he isn't around anymore, right? And you read the book that Walter Isaacson wrote about him, the biography. It's just, and the first question I would ask him is, why didn't you finish so many of your paintings?
He had a lot of stuff he didn't finish, right?
Yeah, exactly. Yeah, actually, supposedly more unfinished than finished. But anyway, the last question is, if you had a time machine, where would you go and why?
Yeah, I would go back to the early mid-90s, around the time I was finishing high school and going into college. And I think I would have still gone into aerospace and done that for a little bit, but I probably would have pivoted to the, more of the high tech world that I landed in later, more commercial world. And I would have, there are some stocks I would have liked to have bought back then and just held on to. and I definitely would have started in real estate a lot sooner than what I did. Like, yeah, if I knew then what I know now, man, I'd be completely done. I'd be one of those people you talked about, like, I just got to beat inflation and I'll never run out of money.
Yeah, absolutely. Yeah, I have the similar thing. If I had a time machine, one thing I would definitely try to do is every station I ever was in my Air Force career to do a VA loan and buy something.
Yeah.
So, yeah. All right, cool. Well, Dan, it was a great pleasure. If somebody wants to get their hands on this ebook or get in touch with you, what's the best way?
Yeah, the best way is if you go to fusionnotes.com/listeners. It's got links to all of my stuff there. And then you can also sign up for the newsletter and get that ebook that I talked about with some of those case studies and like very recent examples of deals I've been doing.
Awesome. So fusionnotes.com/listener, and then we find it. We're going to put that in the show notes. I want to thank you for your time and for your expertise, and maybe we do it again sometime in the future.
Absolutely. Thanks for having me on.
Awesome. Thank you.